Hello. Hello, everyone. Am I audible? Can you hear me? Okay, great. Good afternoon to all. A warm welcome. I'm delighted to see you all gathered here for our webinar today. Over the next hour, we are going to explore in depth the world of macroeconomic indicators and how they can shape your investment decision. Before that, a quick intro about myself. This is Dr. Chitra with you. I'm a professional trainer and tutor. I'm a senior faculty with the Banking Center, and I have PhD in economics, and I'm with BIBF. It's been more than a decade. Okay, so my passion is economics and research. So have published papers in economics and finance. So let's get into the macroeconomic indicators for our right investment. So fantastic. Let's start with what Warren Buffett has to say about investment. Um, just a minute, I'm having a bit of a difficulty navigating my slides. It just gets okay. You can listen to me. Um, so Warren Buffett has said that neglecting macroeconomic indicators in investment is like trying to drive a car blindfolded. Eventually, you are bound to hit something. So it can be positive, it can be negative, right? So I think that explains the importance of macroeconomic variables and why they should matter to us as investors. See, understanding macroeconomic variables is of paramount importance for investors. These indicators are data points that provide quantitative insights into the overall performance and thereby the health of the economy. These indicators are indispensable tools for policymakers, analysts, and of course, investors like yourselves. These indicators help us to decipher the economic conditions, recognize the trends, and spot potential risks on the investment horizon. So these variables includes or they provide, crucial insights into the overall health and stability of the economy, which can impact your investment decisions. So by closely monitoring and analyzing these indicators, we can make informed choices about our asset allocation, risk management, and timing of our investments. So in this context, macroeconomic knowledge acts as a compass guiding investors through the complex landscape of financial market, thereby helping them to identify opportunities, mitigate the risks involved in our investment, and optimize the portfolio for long-term success. So macroeconomic indicators cover a wide range of factors, and they are basically categorized into different types. So how I have categorized them is as output indicators, price indicators, labor market indicators, monetary indicators, government indicators, and trade and balance of payment indicators. I'm sure there are many other than this, but for this discussion, we are going to focus on these indicators. Okay, so let us first, we will explore the output indicators. What are output indicators? These are the metrics that measure the production and output of goods and services in an economy. At the top of this list is GDP, or the gross domestic product. Yes, GDP is the heavyweight champion of economic indicators. It represents the total value of all goods and services produced within a country during a specific period. It's like the pulse of the nation's economic activity. So when a GDP is growing, it typically suggests a conducive environment for investment. So GDP growth rate, it refers to the change in GDP over time expressed as a percentage. As you can see here, I have given the GDP growth rate for Bahrain for the past years. It reflects the expansion and contraction of an economy. So when GDP is growing, it indicates that the overall economic activity within the country is increasing. So this growth is typically associated with the positive trends like employment levels. Consumers are happy, so they are spending, increased business investment, and improved business confidence. So in this scenario, investors often they perceive it as a very favorable environment for investment. For investors, it's very important for you to monitor the GDP growth. It's very important. Why? The reasons are monitoring the GDP growth helps us to understand the investment climate. So GDP growth provides insights into the overall health and performance of economy. So a robust GDP growth signals that it's a vibrant and growing economy which will attract domestic and foreign investment. Business opportunities. See, if there are higher GDP growth, it means that there is increased business opportunities across various sectors. So investors can analyze the growth rates of specific sectors within Bahrain's economy to identify potential investment areas with strong growth potential. It also helps us to know the overall market sentiment and the investors' confidence. So if the GDP growth rate is positive, that tends to boost the market optimism and it can lead to increased stock market activity. The stock prices will go up and very improved investment returns also. Understanding the trend of GDP will help the investor in risk assessment. So contractions or a slower GDP growth rates may indicate that there are economic challenges and there may be a recession. So investors need to assess the impact of slower growth on specific industries and businesses. Thereby, they will be able to understand the potential risks, and thereby what they can do, they can adjust their investment strategies accordingly. Monitoring the GDP will help investors to understand the sector selection. See, the entire country's economy is classified under three sectors: the primary, secondary, and the tertiary sectors. So it's very important for us to understand which sector is contributing to the GDP. So GDP growth rate can vary across different sectors within an economy. So by examining sector-specific growth rates, investors can identify those industries which are outperforming or some are underperforming the overall GDP growth. This will guide them in selecting sectors with potential investment opportunities. Investors should stay informed about government initiatives and policies aimed at sustaining or boosting their GDP growth, as these can influence investment decision. So GDP growth is closely monitored by policymakers who may implement economic policies to stimulate or manage the economic growth. Hence, it will be interesting or it will be a knowledge for the investors to know this so that they can invest in those sectors which are preferred by the government, which will increase their profitability. However, let's not forget the flip side. Contractions or slower growth rates can hint that there are economic challenges or recession. You need to assess the impact on specific industries and businesses, considering potential risks, and you need to adjust your investment strategy accordingly. And we need to understand that even if the GDP is growing, but this growth rate may not be uniform across all sectors. So examining sector specific growth rates, we can identify those sectors which are performing well. So that is very, very important. See, there are some sectors or there are some industries which are pro-cyclical, whereas some are defensive. So depending on the GDP growth or trends, investors may direct their investment to those sectors. Investors normally classify these indicators related to GDP as leading indicators, coincidental indicators, and lagging indicators. For example, consumer sentiment or consumers' expectation, movements in the stock market, up or down, are considered as leading indicators. Retail sales, sluggish demand, or an increase in demand, industrial production, these are considered as coincidental indicators. Unemployment rates, fall in unemployment rate, or rise in unemployment rates, these are lagging indicators. So anything that revolves around GDP gives us an idea about how our investment should be. For example, in Bahrain, during the oil boom years, the country experienced high GDP growth due to significant oil production. This economic growth attracted foreign investment, led to infrastructural development, increased the consumer spending. Investors who recognized this trend and diversified into sectors benefiting from the economic boom, they reaped substantial returns. Moving on to, we have price indicators. These are the watchdogs that monitor changes in the general price level of goods and services. Two key players in this category are the consumer price index and the producer price index. And let's not forget about the big elephant in the room, which is inflation. See, inflation is a silent wealth eroder. Inflation is the rate at which the prices rise over time, and it has a profound influence on your purchasing power. When it is on rise, each unit of your currency buys fewer goods and services than before. That's why it is crucial to grasp the ins and outs of inflation, and that's very important for investors, and they need to watch the movements on the inflation rate. So what is inflation rate? Inflation rate, it measures the rate at which prices of goods and services are rising in an economy, which leads to a fall in our purchasing power. So this erosion of purchasing power, it affects both consumers as well as the investors. And that's why it's very critical to understand inflation and its impacts on investments all over the world. So asset values. See, some assets like real estate, stocks have historically acted as a hedging tool against inflation. They tend to increase in value over time. But other assets like cash, or if you have a fixed income security, they may lose a value during an inflationary environment. Interest rates are another piece of the puzzle. Inflation influences interest rates, and central banks often adjust them in response to the inflationary pressures. So when inflation rises, central bank may increase interest rate so that the spending is curbed and that will eventually lead to a fall in the rate at which the prices are rising. So this can impact, that is a rise in interest rate in order to combat inflation can impact the borrowing cost, your investment decision, and the valuation of certain investments such as bonds or fixed income securities. As investors, your goal is to earn a return on your investment, right? That's what makes you a rational investor. So your investment's return must exceed the inflation rate. Otherwise, you are not making a good return. That's why monitoring inflation rate is crucial to set appropriate return expectations to make our investment decisions that can outpace the inflation. See, for example, if your return is 9% and inflation is 4%, actually your return is not 9%, it is 5%. So inflation removes your real return. Moreover, inflation can shape up your asset allocation strategy. See, certain investments like equities, commodities, or real estate, they have historically demonstrated the potential to provide returns which is much more than the inflation. So by understanding inflation rates, we can adjust our asset allocation to include inflation hedging assets and diversify our portfolio accordingly. So when the economy is moving, it's very important for us to kind of invest in inflation sensitive stocks. So there are, as I told earlier, there are certain sectors which are pro-cyclical and there are certain sectors which are very defensive. So we need to invest in those sectors during when the economy is expanding, and in health sector, in defensive sectors when there is a sluggish growth in the economy. So inflation rates provide insights to the overall economic conditions, hence an economic outlook of the country. So they are one of the very important indicators that we normally look at before we invest. So if there is persistently high inflation, that can be a sign of overheating economy, while low inflation or deflation or stagflation can indicate economic weakness. So investors, it's very important for us to consider inflation rates in conjunction with the other economic indicators in order to assess overall economic health and to make well-informed investment decision. Now let's look at unemployment rates. Okay, so unemployment rates can send ripples through the investment landscape. These rates measure the percentage of the labor force that is unemployed and actively seeking employment. So high unemployment rates can spell trouble for consumer spending, because if people are unemployed, they may not be able to spend the manner in which they were spending when they were employed, right? So individuals who are unemployed or are worried about job security, they tend to cut back on their spending, especially on non-essential goods and services. This in turn affects the aggregate demand, which is the total demand for all the goods and services in the economy. So when unemployment rate is high, aggregate demand decreases, leading to reduced sales and revenues for businesses. So definitely profits will fall and our returns will also fall. Moreover, unemployment rates can influence market confidence and investor sentiment. So high unemployment can create uncertainty and lower market confidence, potentially impacting a very bad stock market performance. Government policies often come into play here. See, change in unemployment rates can trigger government responses, like government will be into job creation program or economic stimulus packages, etc. So these policies can directly or indirectly affect various sectors of the economy, including the stock market. So you may have a positive returns due to the government's policies. Unemployment rates are closely tied to economic stability. So higher unemployment rate, it indicates that underutilization of labor resources. So as an economist, I would say it's an opportunity cost, right? The laborers or the workers or the population is underutilized now, which can lead to social and economic challenges. Conversely, lower unemployment rates indicates a more stable labor market, higher consumer spending, and potentially positive economic conditions, contributing for a favorable environment for stock market performance. But again, I would like to mention here that unemployment is also, we can call it a double-edged sword, because if unemployment rate is high, you will get cheap labor, right? That would be an advantage for the entrepreneurs. They will get laborers at a lower cost, which will reduce their cost of production, which will increase their profit. So they will employ then more workers, that can stimulate the economy. So we need to understand what level of unemployment is acceptable before we invest in a country. Now let's move to how interest rates, which is a very, very um, fundamental aspect of the financial system affect our investment. Interest rates directly impact the borrowing cost, right? When interest rates are low, borrowing costs decrease, making it more affordable for individuals and businesses to take out loan and access credit. This can stimulate the borrowing and investment activities, leading to increased economic activity and a high stock market performance. Conversely, when interest rates rise, borrowing costs increase, which can reduce the borrowings and investment, potentially dampening the economic activity and affecting the stock market performance. So changes in interest rates can influence our investment decisions. So lower interest rate generally make investment decisions more attractive compared to other low risk assets. This can lead to increased investors' demand for stocks and other investment vehicles that offer potentially higher returns than the fixed income assets. So interest rates influence the valuation of stocks through their impact on the corporate earnings and the discount rates. So lower interest rates can stimulate growth, increase the consumer spending, support the corporate's profitability, which can positively affect the valuation of stocks. Additionally, lower interest rate decrease the discount rate, which is the opportunity cost of your decision making, used to calculate the present value of future cash flows, making future earnings of stocks more valuable. On the other hand, higher interest rate can increase borrowing costs for companies, potentially affecting their profitability and the valuation of stocks. So it's worth noting here that the central banks are behind interest rates in Bahrain, even though the central bank did not directly set the interest rate, but through their policies, they influence the interest rate. They make adjustment to interest rate to manage inflation, stabilize the economy, promote sustainable economic growth. So these changes in interest rates signal the central bank's stance on the economy, and their decisions can influence the investor sentiment and stock market performance. So if a central bank is lowering interest rate to stimulate economic growth, many investors will view this as a positive sign, which can lead to increased stock market activity and valuations. Moreover, interest rate differentials between countries can influence the capital inflows and outflows, as well as the foreign direct investment. So higher interest rates in one country relative to another can attract foreign investors who are seeking higher returns. This can affect the demand for stocks in the country if the stocks as well earn more than what is prevailing in other countries. So as foreign investors allocate their capital to take advantage of these higher rates. Let's now look at the government's fiscal policies and its impact on investment. So, yeah, fiscal policies and their impact. See, fiscal policy is the government's playbook for taxation, government spending, budget, etc. So these policies play a very important role in shaping economic stability and can significantly influence the investor's sentiment as well. So sound fiscal policies such as government spending on infrastructure, education, healthcare, and other key sectors can stimulate economic growth and job creation. However, this increased economic activity can enhance the stability by reducing unemployment, improving consumer confidence, and supporting business expansion. Companies will grow, investment will pour in the country, which is a positive direction for our economic growth. Taxation is another critical facet of fiscal policy. Tax policy can impact businesses and individuals, influencing their spending and investment decisions. So any change in tax rates, tax incentives, or tax structures can have direct or indirect effect on the investment. For example, reducing corporate tax rates can encourage business expansion. It can attract foreign investment. It can stimulate economic growth. Similarly, changes in personal income tax or capital gain tax can influence consumer spending patterns and their investment decisions. But it's not all sunshine and rainbows, because excessive or inefficient government spending can lead to budget deficits, and government can have debts, which can be quite disastrous for the country. That's why the budget deficit or even surpluses are key indicators to watch. A budget deficit occurs when the government's expenditure exceeds its tax revenue, resulting in increased borrowings and public debt. A surplus, on the other hand, when the tax revenue or government is more than the government's expenditure, so there will be less debt and there will be increased savings. So investors need to closely monitor the budget deficits, as they can impact the interest rates, inflation, tax policies, and overall health of the economy. So sustainable fiscal policy, which aims to manage deficit or reduce the public debt, can increase the investor confidence, and it will lead to economic stability. So a very well-crafted fiscal policy impact the investor sentiment. Sound fiscal policies that prioritize the economic growth, responsible spending, sustainable public finances are generally viewed as positive signs by the investors. These policies will instill confidence in the government's ability to maintain a stable and supportive business environment. Other very important aspects that leads to or indicators for investment are regulation, country ratings, and perceptions about a country. These variables can have significant impact on the stock market, because these factors influence investor confidence, risk assessment, and the overall attractiveness of investing in particular country's stock market. So here is how each of these factors, let's look at them. Regulation. Regulation protects the investors' rights and it ensures that fair trading practices are there, which will increase the investors' confidence. Investors are more likely to participate in market where they believe their interests are safeguarded. Strong regulatory oversights will help maintain the integrity of the stock market. This includes preventing insider trading, market manipulation, ensuring transparency while reporting the financials, etc. So when investors trust that the market is fair, they would like to invest in those markets. Regulatory stability contributes to overall economic and political stability. And investors prefer markets which with a consistent and predictable regulation, as sudden changes and uncertainty can create, risk and decrease in investments. Regulations, a well-crafted regulation can also impact the market liquidity and accessibility. For example, any restrictions on foreign investment can limit market participation, while relaxed rules can attract more foreign capital. Country rating. Credit rating agencies normally assess countries' creditworthiness, which reflects its ability to meet their financial obligations. So if a country has got higher credit ratings, that will lower the risk and making it easier and cheaper for that country and the government or corporations to borrow money. So this can lead to economic growth and increased investor confidence. So
Hello.
country ratings influence
Hi,
interest rates
Miss.
as well. So a country with a higher rating normally enjoys lower interest rates on its debt, which can stimulate its economic activity. If a country has got lower rating, then that country will have to keep its interest rates high in order to attract more investment.
Hi,
Then
doctor.
only
Sorry to cut
people
you.
will lend money. So
Doctor, can you
foreign
hear me?
investors, they always consider a country ratings when they decide to invest. So higher rated countries are generally considered as safer investment horizons, attracting more foreign capital. One of the very important factor that shapes the investment journey of the investor is perceptions about the country, in which political stability is very, very important. If you look at the country ratings, political stability is given a very high weightage, up to 30 to 40%. So countries with a stable political environments are perceived as less risky, hence they will attract more investment. So positive perceptions about countries' economic outlook, as we discussed earlier about the GDP growth, inflation, unemployment, all this will boost the investors' confidence. The perceptions of geopolitical risk can drive investors away from certain markets. Like if there are
Doctor, we can
disputes,
use
conflicts, tensions in diplomatic relations that can lead to negative perceptions. So there will be a capital flight. The funds will be relocated. Then a country's reputation for business-friendly policies, the law in the country, and respect for property rights can also positively influence the investors' perceptions. So if the investors trust the government's ability to manage the economic challenges, that will act as a positive driving factor. Another very important macroeconomic indicator is the BOP, balance of payment. What is balance of payment? Balance of payment is the country's payments and receipts with the rest of the world. So it's actually a snapshot of a country's financial position. So the BOP, it tracks the payments and the receipts that the country has with the rest of the world, which will have an impact on your investment decision. If a if a country is enjoying a very positive BOP, that is a surplus in its BOP, that reflects healthy investment and it will contribute to economic development. It positively affects the inward investment, which further leads to growth. However, a deficit in the BOP means that the country is spending outside or the money is flowing outside. Hence, a mounting deficit in the BOP can many a times considered as a negative investment indicator. However, we cannot categorically say surplus is good or deficit is bad. What we need to see is where this money is being spent. If, for example, if a country is having a deficit by they are importing technology or machines and these are used for future development and growth, this is not considered as a negative impact on the economy. Right? So we need to analyze these numbers in order to understand how they are going to affect the investment. So that brings us to the end of this comprehensive discussion on macroeconomic indicators and their impacts on our investment. So through this discussion, we explore the critical role that macroeconomic indicators play in guiding investment decision. So to sum up, macroeconomic indicators helps us in providing market insight. They provide valuable insights into the overall health and direction of an economy. They help us to have an understanding of market trends and the potential opportunities. Macroeconomic indicators helps us in risk assessment. We normally use these indicators to assess the level of risk associated with a particular investment. So a robust understanding of these indicators help us to mitigate risk and make more informed decisions. They also help us in understanding when should I invest, the timing and the strategy. So they help us in timing our investment, knowing when to enter the market, what is the good time to exit from the market based on the economic cycles, like when and at what time we should buy inflation sensitive stocks, when should we invest in bonds, when should we invest in stocks, again, what type of stocks, pro-cyclical or defensive. So they help us to understand this, which can have a significant impact on our returns and the performance of our portfolio. Diversification. It helps us to diversify our portfolio because diversification is a risk management strategy which will help us to it will kind of amplify our returns. Macroeconomic indicators make us to have help us to have an optimal asset allocation because a proper asset allocation is crucial for achieving investment goals. So macroeconomic indicators help us in determining the right mix of asset classes, whether we should have stocks. Is it right time to invest in stocks, or is it good to invest in bonds or commodities or real estate, or what should I do? Should I invest in SIP, etc. So it gives us a lot of ideas to have proper asset allocation. It aids us in sector selection. Investors can use this macroeconomic data to identify sectors which are facing challenges or which have got growth potential. So we can have a sector specific insight which will help us in our stock selection. And macroeconomic indicators gives us an idea which economy is performing well, which country is doing good, where should I invest. And it's good for our long-term planning because it helps us to make prudent decisions, patient decisions, which will align with our objectives. And definitely, these indicators are the cursors that will help us to mitigate the risk so that we are ready for the downturns or the financial crisis. And end of the day, investment landscape is very dynamic. So staying informed about macroeconomic developments and regularly updating our investment strategies is very crucial for our success. To conclude, macroeconomics are just not numbers on a page. They are essential tools for investors. They give us the context and data which are needed to make well-informed decisions, manage our risks, and optimize our investment strategies. Please always understand that a solid understanding of these indicators are crucial for your financial success. Thank you all for attending this webinar. I hope this detailed exploration has been insightful, and I encourage you to continue your quest for knowledge in the realm of macroeconomic and investment. Now, feel free to share your questions and insights, and let's have a very fruitful discussion. Definitely, definitely. But my presentation has got just yeah, some. I have taken the most latest data in Bahrain economy, and that is what I have been explaining. I don't know. Suddenly, it just went blank. So basically, what I have done is started with, as you can see, GDP, inflation, and unemployment. I don't know, it's just flips and interest rates. And Bahrain's fiscal deficit, public debt, etc. So these are just the figures, and I have been explaining them, like the country rating, how the debt has been, etc. Unemployment rate, credit rating, how Bahrain is being rated, balance of payment position. So basically, this is what I have included in the presentation. Definitely, definitely, Lujane, thank you for your kind words and appreciation. It's my pleasure to share the presentation with you. I will check with our marketing team how we can send this presentation across. Or anytime, feel free to call us. Happy to, if you have any more doubts or you need any assistance, I'm sharing my direct number with you all. As I said, economics is my passion. So, anything on economics, if you want to have a discussion, feel free. I'm here. Any questions, anyone? Thank you, Salim. Same to you. Okay, thank you so much, guys. It's a pleasure. Stay in touch and all the very best. Oh, Zainab, very good. Happy to hear that.